While we experienced some volatility earlier this year, markets have since stabilized and rallied since the April lows. Equity allocations are up double digits so far year to date, as policy clarity and the potential for the Fed to restart rate cuts has spurred the S&P 500 to all-time highs. However, we are a little bit more cautious on the near-term economic outlook than what is currently priced into markets today. The rationale for the Fed to restart their rate cuts has been a weakening job market, and while employment growth has indeed slowed, the unemployment rate is just off of historically low levels, and the prime age labor force participation rate, or that among people ages 25 to 54, is at the highest levels that we've seen since the late 1990s. And along with demographic trends and just higher asset prices that support retirements going forward, we don't expect that there's going to be a substantial reacceleration in employment growth on a month-to-month basis. And so if employment growth does remain tepid, we would expect that the Fed would likely go back to focusing on the lingering inflationary environment. And while prices have certainly disinflated since the spikes of 2022, inflation's kind of remained stubbornly between 2.5 to 3% for the better part of a year. And tariffs get the inflation headlines, but tariffs only make up a minor portion of consumption and the overall inflation picture. Services inflation, which is a substantially larger impact on consumption and prices, that's been well above the Fed's 2% target for a very long time. And that's more affected by wages than tariffs and trade. And if businesses are suggesting, like they are, that these pricing pressures are going to continue, there's probably a good chance that the Fed is going to refocus on inflation at some point, and delay rate cuts, which will act as a brake on further activity. And this type of environment is typical of a late stage economic cycle, one where we're going to experience slower but still moderate GDP and earnings growth. And this stage can persist for some time, as we saw in the late 1990s and the late 2010s. So we continue to maintain a diversified approach to portfolios, with a focus on quality. While October can be a volatile month for stocks, we remain comfortable with your current portfolio positioning for a slowing but still growing environment going forward.